It is time once again for the Sunday stream. How's everybody doing? I hope you all are having a wonderful weekend. It's going to be 4th of July here soon. Major holiday for the US. Probably will do something else for that day, maybe another stream. So, a lot of interesting stuff going on. So, there was a big Supreme Court ruling, which, for whatever reason, even though it's favorable to SoFi because it shot down the student loan forgiveness, and SoFi's big business is, in fact, student loan refinancing, and why would one choose to refinance what has already been forgiven? So, ostensibly, that's a good thing for SoFi, yet the stock dips after the decision. Who knows what that could be, but yeah, long term, I would say if I was a shareholder in SoFi, I'd be happy about that decision. Granted, if I was somebody with student loan debt, I'd be pretty peeved, but I'm not, so it's whatever. I've also, I'm working on, I guess you could say I'm taking a look at Neo again. I'm going to probably drop a video on that sometime in the next week or so, possibly reevaluating whether or not I was wrong about Neo in the last video I did, which I declared they were not the one. There'll be some comparisons between their valuation and Tesla's and that kind of thing. So that should be interesting. Hopefully, we can glean something useful from that. Also, found a few interesting postings on Reddit and a few of the financial subreddits. This person, first and foremost, has one of the more interesting stories that I've read recently. So, the individual here is worried they're not saving/investing enough, wondering how screwed they are. So, this person's married. They are 45, spouse is 48. Own their home, no mortgage, value of $200K roughly, based on comps. $5,000 in credit card debt with no interest if they pay $800 each month, which that's the weirdest thing I've ever heard with regard. I've never heard of a credit card where you can hold a balance but the interest is zero if you pay a certain amount every month. So either this is some kind of weird Canadian credit card because they say later they live in Canada, or they don't understand how credit cards work. Either would not surprise me, to be perfectly honest with you. $40,000 line of credit, assets. So looks like they maybe have borrowed $40,000 on a line of credit. That's probably not good. Assets, both cars owned. Big box truck trying to sell for $40,000. 4 motorcycles, probably $30,000. So maybe the line of credit had something to do with a business that involves this big box truck, since they have the $40K line of credit, and then the next line, they have a big box truck they're trying to sell for a very similar amount. They live in Canada, medical's covered. Hooray for the Canadian healthcare system. $50,000 in an investment. Now, this is one of the most worrisome things in this whole thing, even ignoring all of that debt. $50,000. They've been told they will get a return of $100,000 in the next 2 years. Red flag, anybody? And possibly more in the future. But this could also become zero at any time. Yeah, that sounds more like they bought like a spin on the roulette table, to be perfectly honest. They can either double up or they can go bust. And $13,000 locked in investment for another 4 years that is secure, low risk. Don't say what it is, though. the way this person evaluates risk, I don't know. Asking how we are doing because we feel like we should have a lot more. Hey, Karan. Welcome. How you doing today? So, asking how we're doing because I feel like we should have a lot more saved or invested for ages. Yeah. Other than the fact they have like their home paid off, yeah, there's a lot of negatives going on here. So, yeah, wow. They both work full time but don't bring in a lot. Combined $60,000 to $75,000. And if that's Canadian dollars, that's like the combined they make less than I do. It's not good for a 2-income household to be making less than just one guy. Sales fluctuates, so hence the range. So they're both in sales, I guess. Asking strangers on the internet to get an unbiased opinion. Hammering down the line of credit aggressively. They're worried about not being able to retire by 65. How can we turn this around, or are we okay? And they go on to try to give some excuse about the $100,000 that they're supposedly going to make from that $50,000 investment. They say it's a startup investment group, and they've already been paid $60,000 on it, and have had it for 4 years, and that helped them pay off their house, etc. Yeah, the thing is, it's very clear to me that they don't adequately understand the investment, and I would just be super wary on buying anything that you don't understand well enough to explain to others what exactly it even is. And they were hoping people wouldn't just say it's a scam, but and it may not be a scam, but it's certainly a gamble, right? So, the level of financial sophistication this person has tells me they shouldn't be putting $50,000 into single speculative investments, right? So yeah, that's definitely worrisome. They got a lot of people, kind of ripping on them in the comments and whatnot. But I would say, if you're this person, unless you want to do the work of doing due diligence on individual investments, which, that takes a lot of time and effort to learn how to do properly. I would say this person ought to just focus on, with their spouse, paying off the lines of credit card debt, etc., and put as much as they can into just, I guess, boglehead type investments. Maybe work on getting their income up so they can play catch up. Because 60 to 75K between two people, that is not great, okay? And we're mid to late 40s here, so they still got some prime working years left. They got to get cracking, and no more playing around with these silly, oh, it's 50K now, could go to zero type things, right? So, on to a little something called NVIDIA. So, a person on Wall Street Bets, of all places, is asking if NVIDIA is overvalued. Ladies and gentlemen, if it's so overvalued that even the people on Wall Street Bets are starting to question if it's overvalued, trust me, it's overvalued. But let's see what this person is basing it on. With Wall Street Bets, it's a hit or miss thing. Sometimes people will actually have good points, sometimes not so much, but in the rapidly evolving world of technology, NVIDIA has emerged as a leading player, known for its GPUs and AI technology. Yep, AI. That's the magic word, everybody. Always with the AI. So, they say it's cyclical, global economy, yada yada, GDP, blah, blah, blah. They're saying it looks overvalued compared to AMD, which is itself overvalued. Now, AVGO, which is Broadcom. Now, this might be a little bit more realistic, right? Another prominent player has healthy EPS, a PE of 27, which is actually what I would consider a premium. I don't usually get into things that have that kind of multiple unless I can run, discounted cash flow and the growth justifies the multiple with conservative assumptions, which that's rarely the case, okay? Rarely the case. So, anyway, AVGO appears favorably valued relative to its earnings. I mean, yeah, compare it. Like, everything is relative, I suppose. Further highlighting the need for careful evaluation within the semiconductor sector. Okay. Like, they're using basically the comparison with Broadcom, which, Broadcom is at closer to, realistic type valuations, but, still, a 27 multiple is still paying a premium for a business, okay? You're paying $27.41 for each $1 of annual earnings. Doesn't say whether that's a trailing or a forward, but regardless, you would have to assume that there's going to be some really substantial growth in that EPS for that to be worth it. And they're basically saying, hey, NVIDIA is at a way, way, way higher multiple than Broadcom, which they're arguing, I guess, is fairly valued. I would say all of it is more than what I would want to pay, but I guess if you want to get through to the Wall Street Bets crowd, yeah, comparing it to another company that's techie and pretty inflated that is just a little bit more close to what's reasonable, yeah, that might be the way to convince them. But let's see what the commenters think. The stock is becoming similar to Tesla in some ways. At these prices, I wouldn't own it, but I wouldn't short it. Yeah. I wouldn't own it. And I don't really short things to begin with, but it's tempting when something is this far into the stratosphere for sure. I didn't hear the Broadcom CEO say AI once. Next. That's pretty prudent there. Pointing out things that they said about AI. Checkmate. Ooh. You obviously like Broadcom. F off and make your bet on them. How to conduct due diligence in 2023. Review number of times AI was mentioned in earning calls. Yeah, that feels about right. Damn straight, Peachy. Yeah, I think it's overvalued too. I just think it's funny to watch. All the sarcastaball happening in the comments here on Wall Street Bets. Their research and development is intangible, and the speculation is wild. Does that mean it's overvalued? Maybe. Nah, it's all a lot of maybes. NVIDIA has a cult following. When you have such a group of people pushing prices of stocks higher, the only thing that matters to them is NVIDIA stock prices going higher. Sounds like Tesla mania. NVIDIA is an extreme case, and they this isn't the actual ticker for Apple, but I I know that they're talking about Apple because they have a bit of a cult as well. Let's see, not have as bro, yeah. Bed Bath & Beyond showed them the way. Yeah. Bed Bath & Beyond, bankrupt, tattooed chef bankrupt. Who could have saw it coming? So this is exactly actually, this comment right here is exactly my problem with the way people look at these companies, okay? Does Broadcom make the A100 or an equivalent? No. Then it's a false equivalency to NVIDIA. Okay, so let's talk about this for just a damn second, okay? All right, what do I have right here? I have a can of Coke Zero. If we were discussing, the merits of, the valuations of Coca-Cola stock, we might compare them to Pepsi, right? When we're saying like, hey, what's, a reasonable multiple to pay in a similar kind of business. What you don't do is when you're trying to shit on Pepsi, which, hey, I don't really touch the stuff anymore. But if I'm going and saying, about the merits of the two businesses, I wouldn't say, hey, does Pepsi make Coke Zero? Well, then it's a false equivalency. That's a lot of bullshit. It's one product, okay? But they make products in a similar space, right? Granted, yeah, like, while I personally don't think Pepsi holds a candle to Coke as far as the product, that's no bearing on which is the more reasonably priced business, okay? And this is also the problem with, people making the comparisons with either Intel, AMD, or whatever in this space, right? They say with regards to Intel, well, AMD makes this and that, and it's better. And, well, okay, you might like the thing AMD makes better, but does that make them a more attractively valued business? Yeah. And I don't usually hang my hat on insider buys and sells, but I mean, the people working, the insiders, they're probably smart enough to realize that even if the future is great and growth is going to be incredible, it probably doesn't justify current valuations, right? So, yeah. And this person claps back, the A100 is just an overpriced gaming card with passive cooling and better RAM. It's not much faster than the R. And here's the problem: they're just having like a dick measuring contest on who knows more about graphics cards. It's not about the graphics cards. Like, I mean, it is to an extent, right? Obviously, you have to make a useful product that fills a need and has consumer demand in order to have a business, right? But like getting into the minutia of whose graphics card is marginally better, that like from an investment standpoint, like, okay, Broadcom is like a 27 times multiple, right? And Nvidia is like hundreds of times. It's like 200 times or something like that. So what you have to do is tell me how does the marginally better graphics card make them worth a multiple that is a 15 times higher multiple than the multiple for the other company? Does this one product make it worth it to pay a 15 times higher multiple? Not a 15 times multiple, but a multiple that is in itself 15 times more than the multiple of the other company, right? So we're talking about the difference between a 27x and like a 200 something x. I dare say that the marginally better graphics card doesn't make the company 15 times better in terms of their future prospects. Yeah. And I say the same thing when it comes to Intel, AMD, whatever. People want to say, AMD, because AMD and Intel maybe is more comparable in a sense, because AMD is kind of viewed as the company that's going to bring down Intel in a lot of ways. And I just sit here wondering, like, okay, Intel has, been at something like, I mean, granted, this is, when their free cash flow didn't get sent negative yet because of capex, but they were at like a 10 or a 12 multiple, where AMD was at like 100 or 150 times or something, right? And I sit here and I say, I mean, are AMD's chips 10 times better, to the point where you should pay 10 times more because their future is 10 times brighter? I don't think so. I mean, people have been saying AMD is gonna put Intel out of business for 20 years, and it just has not happened, and I don't think it's going to happen. But that's been the narrative, right? And to be honest with you, most people, and this is something that these people that are arguing this minutia, and these are internet people, right? If you're on any website actually arguing about this or whatever, you're probably kind of a nerd, probably a little bit more of a computer person, probably on the younger side, right? And so they care more about who makes the better graphics card, not who makes the most money. And when it comes to your investment, where to spend your investment dollars, like, yeah, they'd probably rather buy the NVIDIA or the AMD or whatever, and not the Intel or the Broadcom, because those are boring, right? But really, when it comes to your investment dollars, it's about what will get you the best return, right? What place where you send your dollars will send the most dollars back to you. That's the key. Not who makes the better this or that. Unless the valuations are close, right? So if, let's say, Intel's trading at like 15 times and AMD is trading at, 17 or 18 times, but has a much better, product, right? And probably has better growth or whatever going forward. That's the kind of conversation I'd be willing to have. But if we're talking about, this company is at, 15 or 20 times, and this other company is at 200 or 250 times multiple, it's patently obvious which one is probably somewhere near a reasonable valuation, which one is just astronomical and beyond all common sense, right? That's my only point. Like, and that's why I get back to the Coke and Pepsi thing, right? Yeah, I can sit here and say, this is by far the better cola, right? 100% this is the better cola. Pepsi, not even close. But if I look at the financials of the company, and Pepsi is trading at a more reasonable multiple, and I think if I send my dollars into Pepsi stock, that I would receive more dollars back in the long run, then it seems like Pepsi would be the better investment, regardless of the merits of the individual colas. And people can't see these tech companies in the same way, but it is, in my mind, the same thing, right? It's like, does the difference in the quality, like, here's the point. Regardless of how much better Coca-Cola is, there are still going to be people out there who settle for Pepsi. All right? And you can say the same thing in this world. As long as it accomplishes whatever the product is, exists, whatever need it exists to serve, it'll sell to somebody. Especially if, they can compete on price or whatever, which, somebody like Intel or Broadcom certainly could in whatever they sell, right? You're not going to just get rid of these older technology companies like Intel and Broadcom and just replace them with NVIDIA and AMD like that. Like, they're here to stay in some form or another, and they're probably going to make a lot of money. I mean, the chip space is growing. As the world develops more and more people buy laptops and smartphones and have internet and everything. And so all of these companies will probably get some kind of growth out of that. I don't see any of them going to zero. No, so I said in the beginning, and you might not have been here right from the start, Peachy, but no, I think it's like, so I already said, like, Broadcom, their valuation, I haven't looked at it too closely, but I mean, there's a reason why I don't own a lot of companies that, I can't think of a company that I've bought at like a 27x multiple, right? I think you have to be willing to project a lot of growth to justify that. And it's hard to get to that multiple with conservative assumptions unless there's some exceptions, like technically some companies I bought went negative because of, like, we'll call them either like individual events or whatever. Like Altria Group wrote off Joule, and that write-off technically sent their earnings negative, but their free cash flow wasn't affected, so like I based my multiple on that instead. But yeah, in general though, yeah, I don't think many companies actually justify like a 27 or a 30 multiple. But in this case, what we're talking about is a 27 versus like a 200, right? And one is a lot closer to at least being somewhere near reasonable. Like Broadcom, I bet if I ran the numbers, I'd say, that thing probably has to drop like 30% for me to be interested. That's the inkling I get. I haven't yet, but that's just that's about what I think I would come up with if I had to take a random stab in the dark. It's probably a great company and probably worth like a little bit of a premium for their, consistency and their growth and their ability to produce for shareholders. But I don't know. I have a hard time paying $27 for $1 of earnings, Now, let's see. What else did I have? Got off on a little bit of a rant with the large cap tech, as I often do. Let's see. This is just the general. Oh, right. So here's a different tack. This person wants to know if they're saving enough for retirement. And usually when somebody asks this, the answer is an emphatic no. But this is an interesting case. So this person is a teacher, 34 years old, and they've got 55K split between a Roth IRA and their job's 457B. I don't understand 457Bs terribly well. I did a quick search on them at one point, and apparently they limit what kind of assets you can buy in there to mutual funds and annuities, if I'm not. There may be something else that they allow, but you can't just buy stocks and ETFs and stuff in a 457B. But, mutual funds can be okay as long as the expense ratios aren't too out of control. They put $12.50 a month into that, which is quite beefy. It's $15K a year. And max their Roth IRA, which is $6,500 a year. They plan to retire at 62, and they also have a pension that will give them 63% of their average of their last 3 years of working in terms of their income. So they'll have 63% of their future income, which will be higher than it is today. And retirement calculators giving mixed results. So, think about retirement calculators. I don't know what ones they were using, but this is a simple compound interest calculator. 55K starting. Their annual addition, if you added up what they said they'd put in the 457 plus the Roth, comes out to 21.5. 34 to 62 is 28 years of growth. And I put in 6%. So 6% could mean 6%, or it could mean 8% with 2% loss to long-term inflation, right? So with that in mind, if we take that as 8% with a 2% loss to long-term inflation, they would have $1.8 million in today's dollars, assuming that they got 8%. Or if they only did get 6%, they'd have 1.8 million in 28 years from now dollars, which isn't as good as today's dollars. But also 63% of their income from a pension. And presumably if they own a home, it would be either paid off or almost paid off 28 years from now. So I think this is one of the few cases where this person is actually in a relatively good position. That's, imagine like having that much, in your account, 63% of your income guaranteed to you, and no house payment. That would be dope. Oh, all right, Daddy. You want me to look at FMC, huh? Okay, so FMC Corp. So it's a chemical company headquartered in Philly. Insecticide producer. All right. Well, I hate bugs, so yeah, I definitely agree that, that pension is really the feather in the cap on that dude's situation. I mean, here's the thing. If you're willing to retire abroad, I mean, you could get by on a much more humble situation than what that fellow is going to have. But they didn't really mention anything about what kind of lifestyle or whatever they're wanting, but if they're currently living on a teacher's salary, I would assume 63% of their pay guaranteed. Like, they're probably already saving like 30%, 40%. So just that's probably going to be enough, especially if they've got a paid off home. Like that teacher is going to be 100% fine, in my opinion, in retirement. Assuming they don't pick some donkey mutual fund that charges terrible fees and, underperforms in the market. But, okay, so FMC. So, okay. Not bad growth for a boring old chemical company. What do you like about FMC, Dividend Daddy? Okay. Looks like the last few years they've done a few buybacks. They had like a very small amount of issuance before that, but not enough to really change the math. EPS growth looks pretty strong recently. Free cash flow looks pretty good too. Little bit of a disconnect between EPS and free cash flow, but nothing too concerning. Dividend growth looks... I like that dividend growth. Yeah, this has all the metrics I like. I'm just not sure how I feel about the multiple. I mean, 18x, but... Alright. Actually, let's take a look at the balance sheet. How's their debt look? Only 7.7 billion of total liabilities. Not too out of line for a company their size. Long-term debt only 2.7 billion. That's not bad. Let's see. Shareholders' equity 3.3. I mean, yeah, I guess this isn't really the kind of company you buy like looking for a lot of book value, but because it seems like they're more committed to buybacks and dividends than they are to just arbitrarily growing the balance sheet. Well, we can always run some DCF. All right, let's look at the analysts' projections for a starting point. So, all right, ignore these prices. But let's look at what they think the EPS growth will be. And, of course, the 2023 EPS. All right, so they're projecting $7.90 per share EPS in 2023. So, the shorter term, the analyst projections are generally the more accurate they will be. So we're halfway through 2023 already. So I'm willing to give them the benefit of the doubt and say this is a realistic starting point. The next couple of years, we're still talking double-digit growth, slowing down to single-digit growth. All right, I'll go with a really conservative growth number for them, considering I'm giving them this pretty beefy EPS for this year. So we'll use this as our starting point. So, I'll be more conservative. I mean, the debt isn't like that crazy, but they will have to pay it at some point. So, give them a 12.5% discount rate. However, yeah, the 5% growth might be a little bit low. I mean, they're talking about let's man, I kind of wish I knew what the a little bit longer term outlook might be on some of the stuff they're doing. I don't know enough about like the overall condition, but they were saying the next couple of years would be double digit and then drop precipitously. Let's say 7.5%. Split the difference between the single digits and the double digits. Yeah. Okay. So, yeah, I basically like a little dip here, and I'm interested. Yeah. So, yeah, I think, and granted, like, hey, I'm applying a high discount rate because, like, I don't know how accurate a 7.5% average growth in EPS over the next 10 years actually is for them. I mean, if they can do double digits for the next two, yeah, I mean, I feel like I beat them up a little bit with the higher discount rate and knocking them for their debt. Yeah, I think if they fell to 90, I might be a little bit interested. I'd probably take a closer look. I think just 100, we're just not quite into value territory right now. They're probably pretty close to fairly valued, to be honest with you. They're probably, I mean, I don't think this is gross overvaluation by any means. I just don't know that it's like value investor territory. It's not Ben Graham territory. ADM, huh? Well, I am a man of the people. Wow, 9 PE, huh? Agricultural commodities. Huh. Interesting. Oh, what happened here? Doesn't look like enough share issuance for that to have been like, was there some kind of acquisition in 2021 because their revenue randomly, or was this just like the random supply chain stuff? Yeah, I mean, I don't really care so much about what the historical multiple is. Like, if they have a low multiple and they can return a lot of that earnings to me, and they can grow, I like it. Boy, oh boy, can they grow. Although, God, they've taken, it's a mix of increases and decreases, but I'd say the growth um, outweighs the little hits they've taken for sure. Growing dividend. I mean, honestly, with them being such a low multiple, I'd like to see them focusing more on the buybacks. That fair? But I don't know. Let's see what. Well, I guess let's look at some balance sheet real quick. We might have. I mean, maybe the low multiples because of high debt. Total liability. I mean, ooh, a lot of shareholders' equity. How much of that is goodwill and intent? Not that much. Oh, geez. Huh. Okay, and I want to look at the EPS projections a little bit. Just to, ooh. Okay, that's not not great. So, analysts are projecting declines in EPS on ADM. Yeah, okay. So, now here's the thing. Even a declining EPS. Well, actually, it looks like they're going to take a hit or two and then maybe stabilize. I don't know. Well, we can look at it, but my yeah. So we will give them credit for that tangible book value because their balance sheet is quite good. So, unfortunately, I'm going to at least need to zero out growth for the moment. Actually, might have to make it decline, to be honest with you. Yeah. Although, I mean... I mean, shoot. Do we think I'm beating it up too much? A negative 3% average over the next 10 years in EPS growth, dropping to negative 1%. I mean, I'm assuming basically a slow decline over the next 20 years. And still, with a high discount rate, I mean, it still looks decent. I mean, they could actually, mitigate the EPS decline with buybacks. They've got, They've got the earnings to do it. So you think that longer term? All right. So okay. Yeah, that's true, right? But the problem is, okay, the further out you get from the current year, these analyst estimates become less and less reliable, right? So I'm trying to think of it on the long timeline, right? Because also, this drop to 5 could be followed by another 30-50% jump somewhere also in that next 10 years, right? Because there's clearly some cyclicality to this business. Is that fair to say? And I am trying to beat it up, to be perfectly blunt with you. But I'm trying to take also into account like the fact, yeah, we've seen these kind of 20% hits before, but then they're, followed by these jumps as well, right? So that tells me there is definitely a cyclicality to this. And any commodities-based business is going to have some cyclicality to it. I prefer to catch I have Vale, which is an iron ore company, right, in my portfolio, and their stock chart, has a lot of correlation with the iron ore prices, right? You want me to look at the older years? Okay. Okay. So this only goes back to 2013, sorry. But it's been a little bit all over the place. It's definitely a cyclical thing. Okay, that's an interesting point. So, bottom line was never over $5 per share pre-COVID. Now, granted, this is all very surface level, right? I mean, we're looking at more or less like a pattern of what they've done in the past, but we don't actually know like what kind of efficiencies they may be gaining in the business, what they've done to, keep costs under control. There's always minutia, right? Which we're obviously not going to read an entire 10K this afternoon to figure that out, but like at the multiple they're at with just like very surface level what I'm seeing, it looks pretty interesting. But yeah, that short term decline that's expected, that sharp decline that's expected back down to the $5 level in EPS is a little concerning. But actually, I'm like, just out of curiosity, if we just assume they fell back to $5 per share, but maybe gave them credit for growing like at or slightly below long-term inflation. I mean, I think, pegging food to long-term inflation, which is those two things, because they factor into CPI maybe. And again, remember, we've got this 12.5% discount rate. I mean, it's still not like, this thing isn't like through the roof, right? That's true. Now, despite what some people might try to tell you, I've never actually tried it. And by it, I mean you know, pegging. But I consider myself very open-minded. So, yeah, I mean, we're not... I don't think we're in the realm of, like, stupid overvaluation. As far as corn syrup in the long term, guys, I mean, I kind of, I tend to actually agree with the idea that maybe, corn syrup could have a slowdown. Because, like, I gave up corn syrupy drinks years ago. I'll drink the Coke Zero. I'll drink chemicals. I'm all about the chemicals. A Coke Zero Lemon. I don't think they sell that flavor in the U.S. We've got the regular, we've got the vanilla, we've got the cherry, and they've got like some limited run flavors that are only going to last for a few weeks. But yeah, I don't think we've got the lemon. And I think that is, that's a tragedy and a crime. Honestly, we also, like, for energy drinks, we don't have a lot of the, like, the citron, which is kind of like a citrus or lemon flavor of, like, Monster. We don't have that anymore. They used to have it here. They got rid of it. For some reason, I think, like, the lemon flavors just don't sell well. Maybe too sour for our tastes. I don't know. I mean, I personally, I actually, I like lemon flavor. So for me, it's like a crime and a tragedy that we don't have them here in the U.S. Well, the fact that they've, in some cases, had the different lemon flavors, but then got rid of them, or discontinued them here, stopped distribution in the U.S., maybe tells me that it's not the marketing; it's just the sales doesn't support it. Yeah, unfortunate. But hey, I really like Coke Zero, no matter what the flavor is. Actually, I do take that back. I'm not really that keen on just the plain vanilla Coke Zero. But they used to have like it was like an orange vanilla flavor that I really liked, but they discontinued that one. Yeah. I'm usually pretty good with the different limited run flavors they do too. They're usually, nice for a little bit of change of pace. So, yeah. Coke White. It so are you talking about the powdered variety, or like what kind of white Coke are you talking about? Yeah, the powdered kind, right? The the devil's sugar. Okay. So, yeah, it could be value. I mean, I'd obviously want to understand it a little more, but it certainly could be value. How how beefy is their dividend? So dividend is $1.60 per share, and $75. So like a low single digit on that dividend. It's like what, 2% dividend yield, something like that. I mean, the dividend growth seems like it's pretty nice and consistent. eBay, huh? I don't dislike eBay. I mean, I can't remember ever having used eBay for anything, but it doesn't mean they can't kill. I will say, like, eBay spinning off PayPal. I wonder if they regret that, because PayPal definitely outshines eBay right now. So, I mean, these gross margins are nice. Wow. Although they have kind of come down. They used to be in the low 80s. They're down to the low 70s. Well, yeah, that's definitely true. I mean, look at Altria Group, right? Let's spend $18 billion for 35% of some vaping thing because vaping's the future. I mean, for older folks, eBay has a recognizable brand name that they identify with. Um, and it might, and I will say this about eBay: they do seem to be a little bit more attractive for people who are individual sellers of perhaps like unique items. Yeah, like things you would find in like an antique store or a thrift shop or a pawn shop. That's the kind of thing you would probably go on eBay for. eBay isn't the place where, say, I would list like, if I just had like standard packaged products like laptops and or um, accessories or things like that. But if I had like an antique store or a pawn shop or um, like a thrift store or a flea market kind of thing, I would certainly list some of my like higher ticket items on eBay, like the kind of thing you would have like in a display case or whatever. I would like co-list those things on eBay, right? And I know a lot of those kind of stores do that, right? So I mean that's kind it's a little more niche, right? Like I don't think eBay is gonna be coming for Jeff Bezos's lunch anytime soon, but well, that depends, Peachy. I mean, okay, like how profitable is Etsy? Because with eBay, I'm seeing very good gross margins and some previously somewhat decent EPS, I guess. Although, although it seems very all over the place, a very low predictability, as they say. Um, I don't know how they get more consistent. That's an issue. I see buybacks, and somehow I see dividend. Oh, I mean, their free cash flow actually looks pretty more consistent than their EPS, anyway. If eBay starts offering to send stuff into space, I'm going to be a little concerned. Yeah. So, all right. So, I mean, I feel like I've got an okay picture of the eBay income statement, but let's look at the idea of Etsy being a better play. Mm-hmm. Okay, so I'm gonna try to give it a fair shot. Okay, so I mean, actually, similar gross margins more recently. I'm actually surprised that Etsy has they went from no free cash flow to $5 per share in free cash flow. Color me impressed. So, I mean, I'm not as familiar. So I'm old, so forgive me, but I've never actually been on Etsy. Like, I've at least browsed eBay before, considered selling stuff on eBay before. I've never really looked at Etsy. So if I have like again, like an antique store or a pawn shop or a thrift store or whatever, and I have maybe a few higher ticket items, would I be able to list them on Etsy? I guess I always thought Etsy was for like homemade crafts stuff more so than like, oh, I've got this antique watch stuff. Oh, do they dilute? I hadn't gotten to that. Oh, yeah, dilution is pretty bad. Dilution is bad. I don't like dilution. But is it just me, or did the dilution recently, like, if they stopped diluting, which maybe they have they mentioned anything about maybe going the other direction and starting some buybacks? Because all right, their free cash flow per share was over $5, 84. So they're like a 16 times multiple on their free cash flow, at least their last year's free cash flow. I mean, actually, I don't even know if I'd want them buying back at that level. Maybe if they were cheaper than that, even maybe. But I mean, if they just stopped diluting and they could continue growing without further dilution, yeah, that would be pretty impressive. Do you own Etsy stock, Peachy? Let's look at the... You do not. Okay. Fair. So... So, unfortunately, it's hard to say. I mean, their free cash flow is higher than their earnings per share, so there seems to be a little bit of a disconnect. And, granted, that's kind of normal, but I don't even know if I'd be able to... Yeah, I'd have a hard time. I'd have to dig in more to even be comfortable trying to run a model on this one, because it's a little bit newer and, not as predictable. I wonder what their balance sheet looks like. I hope it's good considering all that dilution. I hope they don't have a lot of debt. I mean, this balance sheet is like 3.6 Rontgen, not great, not terrible, I guess. Like, they don't have enough debt to where, like, I'm worried about them or anything. And they've got a good amount of cash, so... Yeah, I mean, I would agree with the fact that the multiple's too high right now. I mean... Here's the thing. Why is Amazon preferred by buyers? Part of it's the experience, but also part of it's the selection, right? If the thing you want is easier to find on Etsy, the buyers will start to prefer Etsy. I mean, not that I think either, and none of this is coming from, and frankly, I think they appeal to different groups for different reasons in the first place. Like I said with eBay, Yeah, like I said with eBay, it's like it's different stuff that you see, or like if I was selling different things, the kind of things I would list on eBay is way different than what I would consider listing on Amazon. Like an example of what I would use Amazon for. I switched apartments. I needed a new shower curtain and shower rings. I went over to our local Walmart. They were out of shower curtain rings, and I ordered some on Amazon for like $2, and it was, at my front door by like noon the next day. That's Amazon, right? But would I go on Amazon if I was looking for like an antique lamp? No. What would I go on Etsy for? I don't know, because I've never been on Etsy, so I'm not really familiar with what people sell there. I always assumed it was for like, again, like arts and crafts type stuff that people like make. Like, oh, I've got an Etsy shop where like I knit things for cats or something. So I kind of always thought that they were all three in kind of different categories. Yeah, I mean, I get the appeal of like supporting smaller businesses for sure. I'll just say, like, I definitely like. I think both eBay and Etsy probably have their place, but their place probably isn't taking the lunch out of Jeff. You're not going to take a bite out of Jeff Bezos' lunch, right? So, yeah, Ryan can speak to the fact that the younger gens have no money. Honestly, being a millennial, and I don't know if that's young enough to be considered younger gens, but yeah, a lot of people in my generation not only like, you know, are pretty broke, but like have no clue what they're doing. So I worry about the children of the people in my own generation. But I do actually, Ryan. I have a close friend in your generation, and he's pretty good with his money. And I don't know if we became friends because now he's like 22. He's very close to 23 though. And I don't know if that's just like birds of a feather flocking together, and where we get along because we both are interested in financial things. They can scramble $500 for some Air Jordans. Yeah, so who's long Nike? I mean, heck, imagine being able to charge $500 for some pair of sneakers because of the name. That's awesome. I mean, I ordered something from Nike a few weeks ago, and while I won't consider that due diligence, I will say I paid probably about the same as what you pay in store, and they don't have the overhead of having to have like a person actually working at that store to sell me those shoes, right? You were along Nike. So what was your cost basis on Nike? I'm assuming you offloaded it when you felt it was no longer fairly valued. Gotcha. No, I get that. I'm assuming you felt it was appropriately valued around that 70 mark or somewhere in between. And then at 145, you felt it was over, um, substantially over fair value, and felt you could get a better opportunity and realize the gain. Did you get to hold it long enough not to have to pay short term? I mean, I don't know how the taxes work in Europe, but it was even a bit expensive at 70. But, I guess it is well, I guess if you felt it was still a bit on the expensive side at 70, that when it doubled up on you, yeah. Oh, really? So, how does, so just out of curiosity, how does the tax situation work on investments over there? Is it just your gains are your gains and your losses are your losses, and you pay the same tax rate no matter what? Or is it based on how the amount, like, do you pay more if it's a bigger gain? Is it like a progressive system, a flat percentage? Always 25% no matter what, huh? Why does that seem high to me? Does that seem high to anybody else? 25%. But I guess, I mean, you guys do get, like, free healthcare and stuff, right? I mean, most people in the U.S., their highest bracket is the 22%, which short-term gains are realized in that bracket, I believe. Yeah, someone has to pay the health care. Sounds like it's you. But, the fact of the matter is, your system is overall more efficient, right? Because if there's a single payer, that means the providers, the hospitals, doctors, pharmacies, etc., they have to pay or accept what the government will pay, right? So because of that, costs are controlled. In a fragmented system like the U.S., that profit motive keeps keeps prices high, which is part of why I'm actually sort of bullish on healthcare overall. Though I don't like buying like straight up just strictly HMO plays. Like I think I think over a long period of time, people will want to eat away at the health insurance industry overall. They'll want to move down the Medicare age, inch it down slowly but surely. Although I think, honestly, if you were to just, with regards to Medicare, move the age down like 5 or even 10 years from where it is now, overall, that would probably actually help the profits of the insurance companies, because you're still taking people on the older side out of the private pool and putting them into the public pool, and only having to insure people that are less likely to have health problems, so you'd have fewer claims, So that's an interesting thing to think about, but yeah. Nike's dividend growth is a thing of beauty. Ryan, you have some Nike in your portfolio, or like still, don't you? Yeah, so that's a population inversion issue, right? If your birth rates decline too low, basically to have any kind of sustainability or homeostasis with regards to footing the bill essentially for the retired population, and fueling the economic growth that's required for the retired population's investments to retain their value. Yeah, population growth is one thing that helps, or just per capita GDP growth. But as per capita GDP gets higher and higher, like in the case of a wealthy country like the US or Germany, etc., that slows down greatly. And so then you kind of need there to be some kind of movement in population upward in order to continue to, have any economic growth. Demographics are a bitch. So, what's the deal here with this dividend? So you told me this was a thing of beauty. Is this accurate? Doc Martens, huh? I mean, why not, right? Uh, What's the ticker? That's weird. Why on earth does it show a decrease? Was there like a special dividend or something? Very weird. But I do agree that some of these increases were, a 47% increase. That's pretty nice. But then again, yeah. Joey, what's the ticker for Doc Martens? Oh, it's not US listed. Okay. Unbelievable. Joey, are you in the Discord? Yeah. Hey, it's listed in London. That's cool with me. Might be able to buy it on TD. So, Peachy, I have not taken a position in CVS yet. So, you have to keep in mind, I've already got Walgreens, so healthcare-wise, I've already got Walgreens, and I already have MPW. MPW is a REIT, but, it's a healthcare REIT, so I sit here saying, I've got, 15 stocks or something. It's do I want that big a percentage to just be in healthcare? That's the question. Although, yes, I think CVS is on the precipice of being too cheap for me to ignore. All right, so okay, that's fine that the info's off. So, Joey, that's amazing. So it has a moat. Okay, docs. Okay. All right, I'll I'll give them a look sometime. All right, so the Walgreens sinking ship. It's interesting that that's the perception, right? Stagnant, maybe. Sinking, I don't buy that. Heck, I mean, so when I made a CVS video, I had somebody telling me how they hate CVS and they only go to Walgreens now because they had such a bad experience at CVS. Now me, I actually go to CVS, but found it too expensive. Their management hasn't future-proofed their company. Are you talking about Walgreens hasn't future-proofed their company? So, honestly, with Walgreens, I think they've taken more of a beating lately than maybe is justified. And frankly, I think a lot of the one, I think that the opioid settlement is like borderline just it's questionable, right? Like, so I disagree with the idea that stores closing is necessarily bad. Okay, um, there's a lot of, like, for example, if they put a store somewhere where things are economically good and that store does well for a period of time, but then that, I mean, there's a neighborhood Walgreens practically everywhere. But if that neighborhood, experiences some, type of, population drift or something, people leave the neighborhood and there's no longer, enough business there to support that store at some point, it becomes more economically viable to close it. Right? Honestly, you would so you would think that it would mostly be online, and there are some online services to like get your things delivered and whatnot, but you're always going to need like a physical place you can go to get your stuff filled, like if you have something like same day or whatever, or a place to go to like get your actual vaccine shot or whatever if it's injectable. I mean, granted, like I would be totally cool giving myself a vaccine injection. Like that idea doesn't make me uncomfortable, whatever, but they're never going to just like mail you a syringe with a vaccine dose and let you dose yourself. I don't think that's ever going to happen. So I think there's always going to be a need for the Walgreens and the convenience, retail of it, right? Also, something that a lot of people maybe don't think of is that there's people with allergies that maybe like they need someplace that's open round the clock where they can, in the event of like an allergy situation, they can go get whatever it is that they take for that, or asthma if they need to replace an inhaler, like they lose their inhaler and it's like 11 p.m. or something, you go to Walgreens. And right now, imagine Walgreens, CVS, whatever. But let's just imagine Walgreens shuts down, and that was all you had in like a certain area, and you can't go somewhere. There's no other retailer that's open late, whatever. You lose your inhaler. That would be an emergency room visit for an asthma attack. I don't know. I don't think Walgreens is ever going away, if that makes sense. So, here's the thing. I don't necessarily think Walgreens is a better investment than CVS today. Like, if I was looking at them both again today, fresh eyes, I would probably choose CVS instead. Because right now, CVS is at a discount that it hasn't. Like, I think CVS probably is the better overall business. And at the moment, the price to pay for it has declined enough to where I think it's an interesting value. But At the point when I was getting into Walgreens, I thought Walgreens was the better value. But my opinion has shifted. Granted, yeah, I don't know exactly, you know, what Walgreens might or might not be able to do with in the online space and whatnot. There are definitely online solutions, etc. There's that whole Mark Cuban pharmacy thing, but I also know that the retail pharmacies are, I guess, moving more towards like the healthcare hub thing, where you can, you can go get different shots and even get like basic like biometric type like health screenings and stuff done and that kind of thing. Like basically like they see maybe a little bit of the writing on the wall, right? That retail, I mean, retail will always be a thing, but they maybe know that they can't rely on retail to be their bread and butter. Yeah, definitely BTI is always good. And thanks to people using BTI's products, there will always be a need for healthcare too, right? It's a virtuous circle for investors. So, Ryan, since you want stocks that'll be good for 50 years, right? So, I get it. For you, the qualitative means a little bit more than the quantitative in some ways, because if you get a high quality business with a high enough return on invested capital, and you don't overpay too much, and you hold it for 50 years. I mean, just look at Warren Buffett with Coca-Cola. This is a great example, right? So, when Warren Buffett bought Coca-Cola stock back in the 80s, so this is like, you know, 35 to 40 years ago, right? So, similar time frame. Coca-Cola was at a 30 PE. Now, you know me. I hate paying 30 times, right? Hate it. So, he paid about 30 times for Coca-Cola back then. And if you look today and average out what his returns have been since the 1980s on Coca-Cola, it's averaged an 11% annual return for him. So what that tells you is that over if the time frame you're talking about is long enough, paying somewhat of a premium, because 30x for a consumer staple is a premium, right? But Coca-Cola was and I in my opinion still is a pretty high quality consumer staple company, and he averaged, 11% doesn't sound like a lot, and it's lower than Buffett's own personal average, but that's still crushing the market, right? So I personally think that if you're in your late teens to early 20s and you're thinking, what's this going to look like 30 or 40 or 50 years from now, which is how Buffett's kind of approached a lot of his investments, right? It's is this business going to be around 30 or 40 years from now, right? Like, that's a big question that you need to answer. And at that point, will they be more profitable higher revenue, higher EPS, etc. than they are today, right? Those are big questions, especially over the like who's good at accurately predicting what's going to be the case 30 or 40 years from now. That's very difficult to do. If you're extremely good, you might be like 50-50 on your predictions being right. You might get about half of them right. Yeah. So yeah, if you're holding for that period of time, I don't think having like somewhat of a premium is that big of a deal. Yeah, I hear a lot of people saying good things about Texas Instruments. By the way, I'm also in the near future wanting to look at Texas Roadhouse. I've heard good things about them too, speaking of Texas. But yeah, Texas Instruments, I mean, we were using their calculators when I was in, like middle school or whatever. Like they've been in the calculator game a long time. They were Ross Perot's. I don't know if he's even still around or what, but that was his company. I mean, that's dividend growth. And I'm pretty sure this is accurate on this one. Wow. I like that a lot. I mean, although it does look like they are now paying out the majority of their free cash flow in dividends. But again, like, if the multiple's not too bad, what's their EPS again? 951 compared to that. I mean, what is this, like a 20? That's like a 20x, something like that. So yeah, I mean, Texas Instruments definitely. If you think that they're going to keep, having, pretty decent growth and find ways to drive value for shareholders, yeah, if you're going to hold it for 50 years and you think it's still going to be around and that EPS will be higher, etc., and you're very confident in that, is it really that big of a deal to pay 19x or 20x instead of 14 or 15? If you're very confident that they will still be around and still be a great business decades from now, that's a good. I mean, that's. Now that doesn't mean you should just pay anything, of course, right? Because like let's say that instead of 180 a share, it was like 500, right? At some point, at some point you can overpay for a good thing. I don't want people to think that I mean, because valuation is, one of my favorite words, and I always try to base what I'm paying off of some type of valuation. Come up with the price you want to pay and act accordingly based on that. Don't try to make your price fit what the current stock price shows. Yeah, Nvidia is a great business, but even with amazing growth and stuff over the next, even if it's great over the next 10 years, it has to slow down at some point, and 200 times or whatever the multiple is right now is not amazing. So UPS, okay, so low to mid teens multiple on this thing, but I've So I see a big issue with even basing anything off of their current or recent past in terms of earnings or cash flow. Like, do we see the numbers they had before? Like, and all of a sudden, we have these tremendous jumps from low to mid single digit EPS and free cash flow per share into, you know, 10, 12, 13, 14. Like, that's it's concerning to me. Like, how do you create a realistic forecast of that? Because UPS is already a big business. If they're having jumps that high all of a sudden, after consistently posting much lower numbers, and analysts think it's going to grow from here after a little bit of a drop. Honestly, all right. So if the analyst projections are true that they're going to kind of stay around this area in terms of their earnings and grow it from here, it might be okay. But man, like, what changed about UPS from, most of the last decade, like 8 out of the last 10 years versus the last 2 years? I gotta cry foul on that a little bit. I just don't think we can assume after just a very small pullback that they're gonna just continue growing from here unless something's changed with their pricing to where this is now the new normal. And it's not even like their gross margins haven't even really changed, although that's a weirdly high gross margin for a business like UPS. Yeah, I don't see. I can't think of anything about UPS that's changed so much in the last couple years that would be sustainable. Like this looks suspiciously like some kind of a COVID boom in their earnings, and I don't know how sustainable it is. I mean, maybe you could argue the analysts. You could argue the analysts know better than I do, but I do know analysts can have a bias and a tendency to be optimistic, and I prefer to be conservative. The Tesla semi will 10x their margins. Oh gosh, don't start with that kind of thing. Yeah, I'm suspicious about the recent, like, if we felt that the recent results were going to be sustainable and we were really confident, but man, I can't ignore how UPS has performed for seemingly whatever the portion is of the past that we can actually look at, and then all of a sudden there's this dramatic shift. And sudden and dramatic shifts, you would think they could reverse just as suddenly and dramatically, so that's concerning. Yeah, they have a duopoly with FedEx, that's true. I mean, unless you count DHL and stuff, but yeah. Yeah, it's true. I mean, I see those Prime vans out there doing a lot of deliveries now too. So, yeah, I don't know. I don't love UPS. I'm just a little shaky on it. And hey, I mean, I just think there might be places I would rather send my investment dollars, Yeah. Here's the thing. Do they include P bottles as a fringe benefit for the last mile drivers? Just kidding. Just kidding. All right. So let's see here. So what do you guys think about Tattooed Chef finally seeking bankruptcy protection? Like, who knew? Who knew that would happen? Nice. It's good to know. Yeah, I know. Who could have guessed? I mean, back here it was all, oh, look at this revenue growth. And, like, at the very same time, they were being diluted into oblivion, right? Now, here's the thing. Like, I wouldn't be so critical of the dilution if the top line, like, if there was sales growth, like, kind of matched up, right? Because then you could argue, like, hey, at some point, they're going to reach the scale at which they can turn a profit with these 15 or 16% margins. Heck, if they could have maintained those margins and achieved. Now, one thing I missed, actually, in my Tattooed Chef video I did the other day, I had mentioned that, an interesting piece of due diligence, because scale's the issue, I think, right? Because when you have limitations or even compression on your margins, I mean, they went negative here, your scale and your pricing power and stuff like that start to matter a lot more, because you have to squeeze bottom line profit. So you have to, like, this is just your revenue less your cost of goods sold, but then you have to overcome your overhead, your SG&A and all that, right? So to do that, you have to achieve a certain scale when your margins are that low, right? You have to make up for it in volume and efficiency and everything. So that's why I compared them to Tyson Foods, right? Because Tattooed Chef, it's, plant-based, vegan, whatever. Tyson Foods, it's meat-based. It's pork and chicken and whatnot, right? And, a lot of it is on, like, in the same frozen food section. So, like, they're competing for the same shelf space, etc. And, their gross margins are kind of in a similar range, right? Tyson, it's more in, like, the 12-13% range is what it seems, where it seems like they've had some worse years, but in spite of that, they've actually remained profitable, which speaks to, again, my point that when you have margin issues or margins that aren't super, super high, you need to make up for it in scale. So, and Tyson is, doing tens of billions of dollars in revenue. Now, here, right. Negative gross margin will never be acceptable. I mean, but if you had some pricing power, enough volume, you might be able to get your cost of goods down if you're buying enough in a lot of cases, right? So their gross margins may not have gone negative if they had enough volume, if that makes sense. But the point is, vegans are about 3% of the consumers. 3%. So Tyson's kind of the big boy in the meat space, right? We can agree on that. And, they sell, there's a lot of frozen, things of meat in the frozen food aisle at every supermarket I've ever been to that have that Tyson Foods on them, okay? And I don't know of any particular meat company that sells more frozen food than Tyson, okay? Off the top of my head, there may be one, I'm just not familiar. So I would peg the, again, here I am pegging the probably best case for Tattooed Chef would be to get somewhere in the 3 to 5% range of the size of Tyson Foods in terms of like their overall sales. So 3 to 5% of, 53 billion would be like 1.5 to 2.5 billion in revenue, which, granted, yeah, that was a lot higher than what Tattooed Chef was doing. They were only maybe 10% of the way there, right? So yes, Tattooed Chef ultimately, if everything played out, could have become 10x its current size. The problem is that's kind of like their cap of like where the growth would stop. And the fact is there's also, I think there may be too many players in the space too, because you've got your Beyonds and your what are some of those other meatless food companies, right? That is true, right? Yeah. It may be just that the frozen food aisle isn't really where a lot of vegans do their shopping to begin with. I mean, that's true. But I don't think even 10 times their current size would have been enough to overcome that scale issue. Or in order to do that, in order to get there, they would have had to dilute like 10 times, the dilution would probably even outpace the growth as had been the case in the past. So like if you were buying it for 20 or 30 bucks a share or whatever, what were their highs? I think it was like 20 bucks a share or something like that. I mean, how would you have made money? It's like I can't wrap my head around how they thought that this was going to be a moneymaker, because it's like you pretty much got a cap on their sales of probably between $1.5 and $2.5 billion, just based on how many people are vegan. If you compare them with like one of the big boys in the frozen meat space, right? Frozen plant-based versus frozen meat. This is supposed to be the alternative, unless you think maybe veganism is going to randomly take off and become a much bigger percentage of the population. But it's like you can't predict that accurately, Jeremy Lefebvre. Okay, it's silly. Yeah. The stock market always prices in every information efficiently. Oh yeah, totally. No, but this just looks to have been absurd on the face of it. That's my point. And the fact is, like, yeah, they might have, if they were able to sustain some level of profitability and actually survive, they might have eventually gotten to that 1.5 to 2.5 billion revenue or whatever. But again, the signs weren't showing that they were going to be very profitable on it, if at all. Because again, with margins that are this low and susceptible to being compressed by whatever, you've got to be able to make up for it in scale. And I just don't think they would have ever achieved it, personally. I don't think they had enough runway, like enough headroom of I think that there's too low of a cap on how high they could actually reasonably grow to when they were like a fully mature company to ever actually be a realistic moneymaker long term. Like, even if they had turned profitable, like, okay, they would stagnate around 1.5 to $2.5 billion in revenue, and then what? Like, maybe grow with long-term inflation, and the shareholders that funded them getting there get diluted into oblivion, and then make what, like 1% return or something It's terrible. It's terrible. You can't even. I just can't even with somebody putting over $1 million into this and encouraging people that pay them. That's the crazy thing, is that dude puts $1 million of his own, or more than, because that was just his loss, right? It was over $1 million that he lost. Plus, people paid him money for him to like tell them that this was a good investment. Can you believe that? Imagine paying somebody thousands of dollars for like advice or whatever, and they tell you to put your money into something like this, and not only did you pay them, but you then also have to eat whatever you lost. That's terrible. Gosh, it's embarrassing. And even like as he sold, I remember there was a video where he was like, "Oh, they could still like turn it around and whatever." It's like, no, they couldn't. No, they couldn't. Unbelievable. This and Bed Bath and Beyond, man. Like, I saw so many people just, clinging to their hope with Bed Bath and Beyond. Drives me crazy. Like, why would people rather chase that stuff than buy good, legitimate, money-making businesses that could actually turn a profit for them? You know what I think is speculative? Palantir. Palantir is also speculative, okay? And people have pumped this thing, like crazy as well. But you know what the difference is? Let me pull up quarterly here to show what I'm talking about. So, at least with Palantir, there's a little, and granted, like, this isn't tremendous or anything, but we're seeing a transition from, mostly negatives into consistently positive free cash flow, okay? And then also they went from negative EPS to slightly positive EPS. So there at least is something there with which you can, there's a signal there, a sign that this may be a financially viable company, right? Oh gosh, GameStop, yeah. So the beginning of, I guess my current journey started around that time with the GameStop thing, and then co-mingled with the AMC thing. A lot of people, I will say, learned a lot of the wrong lessons at that time. A lot of people got involved for the first time around that time and learned a lot of the wrong lessons and have never reevaluated since. And that's a problem. But that being said, so when Palantir got to like a really cheap point, well, cheap for compared to its own historicals, and simultaneously was showing us potential for profitability along with consistent free cash flow, that's when I took a little bit of a chance on this, right? But by no means would I tell somebody, you should, dump a bunch of money into Palantir. It's for sure a winner and all this. It's speculative, right? They could make something happen. All right? And there's some justification for that. That's the point. That, to me, is an acceptable speculation. Something that has dropped sharply in price, just as it's showing signs that, hey, there could be something here. Now, yeah, it's possible that, granted, like, actually, I could exit this thing for more than 100 and something % return right now, actually. But I'm more curious to see if, it works out as like a long-term investment, because it was a tiny little sliver of the overall investing portfolio, right? You don't make your speculative thing with a newer company that hasn't had any like proven anything. You don't make that a big chunk of your portfolio. That's like position sizing. I think is something that people don't really think about enough. Just because something could be a good investment doesn't mean it should be like a giant chunk of what you have. In any case, wow. We have gone for almost 2 hours today. I think this is a record for me, so appreciate all you stopping by and joining. By the way, there's like a join button. I am looking to hopefully get a few members in the channel. That would be sweet. There will be, once I have them, member-only polls and things of that nature. So, and I started the membership levels like super low because, like, honestly, I'm not a greedy pig, and I care more about the participation and stuff like that more so than the money. This is fun for me, and hopefully fun for all of you as well. Hope the rest of your Sunday goes nicely. If it's bedtime where you are, sleep well. There's a holiday here in the U.S. on Tuesday, so it's kind of a holiday week. A lot of people on vacation and stuff. So we'll see how that plays out. And I believe the market closes early tomorrow, so I would actually probably expect low volume and everything. I hope you all have a wonderful afternoon, evening, whatever it is for you where you are in the world. I know we had some company from Germany today. And hope you all have fantastic time with whatever you do after this and a wonderful week ahead. You'll be hearing from me again, I'm sure. Take it easy, everyone.